Something just happened inside the Federal Reserve that most investors completely missed. Not the headline that the media was talking about, not the part they put in the press release, the part buried in a single document that has historically preceded some of the most explosive moves silver has ever made. And right now, today, that signal is flashing again. If you've been watching silver over the past few weeks and wondering why it seems to be moving sideways while the financial world is in chaos around it, this video is going to give you a very different way to look at what's actually happening. Because what the Fed just did is not what it appears to be on the surface, and the investors who understand the real meaning behind it, the hidden meaning, may be positioning themselves right now for a move that most people will only understand after it already happened. Stay with me, because this gets more important the further we go. If you're new here, welcome to Gold and Silver Intelligence. Hit that subscribe button and the bell so you don't miss what we cover next, because this story is moving fast. Now let's get into what actually happened. On June 17, 2026, Federal Reserve Chair Kevin Warsh held his very first press conference as the new head of the world's most powerful central bank. Markets were watching closely. What came out of that meeting sent shockwaves through stocks, bonds, crypto, gold, and silver within minutes. 9 out of 18 Fed officials now expect at least one interest rate hike before the end of this year. The median dot, that's the projection that signals where rates are going, jumped from 3.4% all the way to 3.8%. The Fed's own inflation forecast was raised to 3.6% for 2026, up sharply from 2.7% just 3 months earlier. And forward guidance, the language the Fed has used for years to signal its next move, was stripped completely from the statement. Gone. The immediate reaction? Silver fell, stocks fell, the dollar rose. Traders read that meeting as bearish for precious metals and sold first, asked questions later. But here's where things get interesting, because the surface reading of that meeting, the one Wall Street ran with, may be exactly wrong when it comes to silver, and history is very clear about why. Let's go back to what actually drives silver prices at the deepest structural level, because this is where the hidden signal is buried. Silver is not just a monetary metal. It's not just a safe haven. Silver is the only major asset on Earth that sits at the intersection of monetary policy, industrial demand, and physical supply constraints simultaneously. That dual nature is exactly what makes the Fed's signal so important right now, and so misunderstood. When the Fed raises rates, or signals hikes, the conventional wisdom says precious metals go down. Tighter money means a stronger dollar, and a stronger dollar means silver gets cheaper in price terms. That narrative is simple. It makes sense on the surface. And it's why silver dropped after the June meeting. But that is only part of the story. Here's the detail most people miss. Every single time in modern history that the Fed has shifted into a hawkish stance while inflation remained persistently above their 2% target, meaning they were raising rates into a high inflation environment, the result was not a sustained decline in silver. The result was a period of intense volatility, followed by a violent repricing to the upside. Why? Because the moment the market realizes the Fed cannot actually tame inflation without destroying the economy, confidence in monetary policy breaks down. And when confidence in monetary policy breaks down, silver becomes the most undervalued asset on the planet. Think about what the Fed just told us. Inflation is running at 4.2% year over year. Their own projection now puts it at 3.6% by year end. They raised rates multiple times in 2025. They are now considering raising rates again. And inflation is still not going back to 2%. That is not a story about a central bank winning the inflation fight. That is a story about a central bank that is stuck. Now here is where the situation becomes much bigger. Because the Fed's hawkish signal isn't happening in isolation. It's happening against a backdrop of supply and demand conditions in the silver market that have never existed before in recorded history. In 2025, the global silver market ran its 5th consecutive annual supply deficit. Demand outstripped production by somewhere between 160 and 200 million ounces. Industrial consumption, driven by solar panels, electric vehicles, AI data centers, and advanced electronics, now accounts for roughly 59% of all silver demand globally. Solar alone is consuming more silver every single year and shows no sign of slowing. And here's the contradiction that should stop you in your tracks. The Fed just signaled higher for longer interest rates because the economy is too hot and inflation is too sticky. But higher interest rates slow down construction, slow down capital investment, slow down the build-out of the very infrastructure that runs on silver. Meanwhile, the same economic strength the Fed is responding to is driving industrial demand for silver through the roof. The Fed is in a trap, and silver is caught between two forces pulling in opposite directions, which is exactly the kind of tension that tends to resolve explosively in one direction once the pressure breaks. Think about what happened just months ago. Silver hit an all-time high of $121.62 an ounce in January 2026. That's a gain of over 147% from where it started 2025. And then, after the Fed's June hawkish pivot, it pulled back to the mid-60s. Nearly half of its gains, erased in a matter of months. That alone would be important. But something else happened at the same time. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has now expanded back to roughly 64 to 1. For context, in April of 2025, that ratio hit 105 to 1, a generationally extreme reading that signaled silver was deeply undervalued relative to gold. When the ratio compresses, meaning silver outperforms gold, it's because the market is recognizing silver's dual value. When it expands, like it has now, it historically marks periods of accumulation for long-term investors before the next major leg higher. Here's another thing worth knowing. Russia formally included silver in its National Reserve Program for the first time in the modern era. Their 2025 to 2027 federal budget allocated significant resources specifically to acquire silver alongside gold, platinum, and palladium. That has never happened before. When sovereign governments start treating a commodity as a strategic reserve asset, something has changed in how that asset is perceived at the highest levels of global finance. What happened next changed everything. Kevin Warsh, the new Fed chair, made a statement during his June press conference that almost nobody picked up on. He said the Fed would become more dependent on incoming data and less reliant on forward guidance. In plain English, he is telling markets that the Fed's next move is no longer telegraphed. No more roadmaps, no more predictability. That single shift in communication style is one of the most bullish things that could happen for silver. Here's why. When markets don't know what the Fed is going to do next, uncertainty rises. Uncertainty drives safe haven demand. Gold and silver are the oldest safe havens on Earth. Every time central bank credibility comes into question, whether because of inflation they can't contain, unpredictable leadership, or policy reversals, money flows into precious metals. Warsh has, intentionally or not, created an environment of maximum policy uncertainty, and silver tends to thrive in exactly those conditions. We now have the LBMA analyst survey showing an average silver price forecast for 2026 of $79.57 per ounce, with the range running all the way from $42 on the low end to $165 on the high end. Bank of America has flagged a bull scenario where physical shortages alone could send silver anywhere from $135 to $309 per ounce if supply constraints intensify. Deutsche Bank has a $100 price target. These are not fringe projections. These are institutional forecasts from some of the largest financial institutions in the world. Now let's zoom out and look at the complete picture, because this is where the major revelation comes into focus. The Fed just signaled it may raise rates in a world where inflation is already at 3.6% and rising. That pushes real rates higher in the short term. Silver falls. But inflation isn't falling fast enough to reach 2%, and the Fed knows it. The same supply shocks, fiscal deficits, and structural demand pressures that drove inflation in the first place have not gone away. The sixth consecutive silver supply deficit is already underway. Industrial demand continues to grow structurally. Russia and other sovereign nations are accumulating silver for the first time as a reserve asset. The gold-to-silver ratio is sending the same signal it sent before every major silver rally in the past decade. And now, for the first time in years, the Fed chair himself has told markets there is no roadmap. No forward guidance, no predictability. What does all of this mean for the investor watching this video right now? It means that what looks like a bearish Fed signal on the surface, the hawkish dot plot, the removal of easing language, the possibility of rate hikes, may actually be the setup for the next explosive leg higher in silver. Not because the Fed is doing something good for silver, but because the Fed is revealing something it cannot hide. That inflation is winning the battle, that policy credibility is eroding, and that no matter what the dot plot says, the structural forces driving silver demand are not going away. The investor who understands this distinction between what the Fed is saying and what the Fed's actions are actually revealing is the investor who is positioned before the next move, not after it. This is the hidden signal. Not the rate projection, not the dot plot, the deeper message underneath it all. That a central bank unable to tame inflation while facing exploding industrial demand and tightening physical supply is one of the most historically reliable conditions for a silver breakout. What do you think? Do you believe the Fed's hawkish pivot ultimately sets up the next leg higher for silver? Or do you think this time is genuinely different? Drop your answer in the comments below. We read every single one, and this community always has some of the sharpest analysis anywhere on this platform. If this video gave you a perspective you hadn't considered before, a like takes 2 seconds, and it helps us reach more investors who need to understand what's actually happening in these markets. Share this with someone in your life who is watching gold and silver right now and wondering what to make of all this volatility. And if you are not yet subscribed to Gold and Silver Intelligence, now is the time. The story we just walked through is not finished. The next chapter is going to be determined by data points coming over the next 60 to 90 days, inflation reports, employment numbers, and the next FOMC meeting on July 28th. We will be here covering every development as it happens. The Fed sent a hidden signal. Most people missed it. Now you know what it means.